Because oil crossed $100 a barrel for the first time since 2022, markets spent Friday pricing in a scenario they had dismissed just weeks ago, a Federal Reserve rate hike. Brent crude rose 2.9% to $104.81, up from roughly $70 before the Iran war began on February 28th, as Israel struck Iranian nuclear facilities in Iraq and Yazd, and Iran's IRGC promised retaliation that would be no longer an eye for an eye. The Strait of Hormuz, through which a fifth of global oil normally flows, remained under Iranian toll control, and Trump's April 6 deadline for its reopening gave markets a countdown clock rather than a resolution. The S&P 500 and Nasdaq extended their longest losing streak in nearly 4 years, with the Nasdaq now more than 10% below its record high. The mechanism linking oil to rates runs through inflation expectations, not through the Fed's stated policy. Treasury yields climbed to their highest level of the year, the 10-year being 4.47%, up 51 basis points since the war began, because bond markets are repricing the probability that the Fed will be unable to cut rates as oil keeps inflation elevated. The Atlanta Fed's market probability tracker now places the odds of a rate hike within 3 months above those of a rate cut, a reversal from February when cut odds stood at 60%. Polymarket and Kalshi bettors assign roughly a 20% probability to a full hike by year-end. The OECD's forecast of 4.2% U.S. inflation in 2026, far above the Fed's own 2.7% projection, is what makes this credible. Some economists, like Natika's CIB's chief U.S. economist Christopher Hodge, argue the Fed will look through the energy shock and still deliver 2 cuts, reasoning that $100 oil is effectively a tax on consumers that suppresses demand and ultimately justifies easing. That counter scenario is the fulcrum. If the Fed signals it agrees with Hodge, the rate hike premium collapses. If oil holds above 100 through the April FOMC meeting, the market's hawkish repricing accelerates. The same inflation fear that locked the Fed into inaction landed unevenly across big tech, and the damage was sharpest where AI capital expenditure was already straining investor patience. Microsoft fell 24% year-to-date, its worst quarterly performance since 2008, not because revenue disappointed, but because a hiring freeze in its cloud and North American sales units arrived while CapEx ran at $37.5 billion in a single quarter, with projections of $146 billion for the full fiscal year. Azure grew 39% year-over-year, yet the market is discounting that growth because Microsoft is allocating scarce AI hardware to internal projects rather than to paying cloud customers, directly capping near-term revenue. Meta compounded its own pressure. A Los Angeles jury found the company negligent in protecting minors on its platform, following a separate New Mexico verdict ordering $375 million in penalties, and shares fell more than 12% for the week. Zuckerberg's response, expanding the Louisiana AI data center investment to $10 billion alongside utility Entergy, signals that Meta is doubling into infrastructure spending precisely when legal liability is widening. Nvidia's valuation slipped below the S&P 500 forward multiple for the first time in 13 years, reflecting the market's broader reassessment of whether AI infrastructure spending is returning capital fast enough. Micron, which began mass-producing HBM4 memory for Nvidia's Vera Rubin GPU, remains the outlier. Up 37% year-to-date, its balance sheet nearly debt-free, and positioned as the only American firm in a memory market where shortage conditions are expected to persist through 2030.
A separate mechanism drove the day's steepest single-sector sell-off. A leaked report that Anthropic is developing a cybersecurity-focused AI model called Claude Mythos triggered a repricing of competitive risk across the entire established security platform industry. Palo Alto networks fell 6% to $146. Okta tumbled 7% to $73.50, and CrowdStrike dropped 6% to $368, all running well ahead of the broader tech sector's 1.3% decline. The logic is structural. If an AI-native model can automate threat detection and response at scale, it commoditizes the premium-priced products that incumbents like Palo Alto, which reported $6.30 billion in next-generation security ARR, up 33% year-over-year, have built their moats around. Okta is more vulnerable. Its FY 2027 revenue guidance implies just 9% growth, and deceleration makes the stock far more sensitive to any competitive threat. Palo Alto's own AI expansion, Prisma AIRS, AI Agent Security, may prove sufficient insulation, or it may not. Investors chose not to wait for confirmation. The Claude Mythos leak has not been officially confirmed by Anthropic, which means the actual competitive threat may prove smaller than Friday's reaction implies, a fact that will matter sharply when and if Anthropic makes a formal announcement.
3 watch points will determine whether this week's sell-off steepen or stabilize. First, Tesla's Q1 2026 delivery report is due by March 31st. Polymarket assigns a combined 92% probability to deliveries below 375,000 units, which would mark another year-over-year decline and remove the last argument that demand is stabilizing. If deliveries surprise above 380,000, the short pressure that has driven TSLA down 20% year-to-date reverses quickly. If they miss, the stock loses its forward narrative. Second, Trump's April 6 deadline for Iranian compliance on the Strait of Hormuz is the event that either breaks the oil rate feedback loop or accelerates it. A credible ceasefire path sends oil back toward $85 and gives the Fed room to signal patience. Failure to reopen the strait, combined with the first Iranian counterstrikes on U.S.-linked assets, pushes Brent toward $110 and makes the 20% rate hike odds on Kalshi look conservative. Third, the cybersecurity sector's next catalyst is any official statement from Anthropic about Claude Mythos. Confirmation transforms Friday's repricing into a fundamental shift. Denial or silence allows the incumbents to recover ground as investors reassess whether an AI language model can genuinely replace purpose-built security infrastructure at enterprise scale.